We actually feel that as long as the rates don't rise again, that actually the market is very much pricing in the current scenario. We're not predicting very, very dramatic drops in interest rates. And, commercial property and residential to an extent can still thrive in this current rate environment. It's all about the correct pricing.
What is different from the market approach to your approach, though, is that the market is putting its bets on AI. And if I look at your portfolio, you're not. Where are the data centres? Why are you not investing in a whole string of data centres? And why are you still focused on office blocks and shopping centres?
That's a great question. The answer simply is that there are very few listed companies in Europe that have exposure to data centres. We are exposed to essentially there are two that have it. One is Merlin in Spain, the other is Segro here in the UK, and we are invested in both of those. We have very little exposure to office markets in London. We do have some regional exposure through other parts of Europe, much smaller cities, where essentially there's been a very strong return to the office. Essentially, if your commute is half an hour, why not go back to the office, which is the situation for lots of office workers around Europe.
So what, prime is always prime, so it'll always be insulated to a certain degree, but I think we all had this existential shock that was COVID. Now we're trying to work out where we are, and you and I were sharing anecdotes about coming back to the office or not before Karen started the interview. But in terms of, you said you've got very little London office. Is now the time to start looking back at London office and saying, actually, we've seen the worst of the work from home movement. Actually, now people are coming back and there is perhaps less new build being built, and actually the supply and demand dynamics looking slightly different? Absolutely.
If you can get exposure to the right product at the right time, and your point is the key one, there isn't enough of the right quality of kit. Businesses are realising that the most valuable part of their business is the people. And actually wage inflation has been dramatic. Costs of rents have not risen in real terms very much at all. And as a result, I think the vast majority of businesses are not that price sensitive at the very top end of the game. The problem for all of us is there's an awful lot of secondary and tertiary real estate out there, but it's not really owned by the listed companies. And that's the important thing, is that the listed companies have almost best-in-class portfolios.
Some of the listed companies have had their own problems as well. I look down at the Wharf as well. I look at what's going on there and the move to have mixed usage, or switching from originally office-designated property to residential and retail as well. What is going on down at the Wharf? Just from your casting an eye on that, which is, probably half of our audience in London work down there.
Yeah, no, we keep a very close eye on it, because it's like watching a slow motion car crash. We have no exposure to the Wharf at all, and the problem with it is it was always essentially sort of overflow space for the city, but it created a fantastic type of structure for businesses that wanted large trading floors, etc. There's just too much of it and not enough demand. The estate is looking older, but as a mixed use environment, particularly as almost like a new town with a lot of residential, it will thrive, and it's essentially going to reinvent itself.